China's hiding? A meltdown. I'm Steve Van Metre. Exports are crashing, sentiment is plunging, and unemployment is rising. China's covering up a collapse so big, it's going to hit us all. Now, let's pick today's story up with a headline. As Beijing stops publishing hundreds of statistics to cover up economic collapse. And I want to understand this is a game of economic chicken. Who wins the trade war is the one whose economy survives and is the strongest. And if you're publishing data showing your economy is collapsing, well, you're giving the other side a lot of data. Now, the U.S. has handled it a different way. The Bureau of Labor Statistics came out and created 300,000 fake self-employed jobs on the last non-farm payroll report. China just said, well, we're just going to stop publishing data altogether. Weeks ago, we covered a story about how Chinese factories are shutting down, laying off workers, putting them on furlough. Many said that this wasn't the case, that the Chinese economy was strong, but we knew the evidence actually was contrary to that, suggesting that the Chinese economy was facing major pain. And now the fact that they're shutting down their economic statistics is validating that they're in far worse shape than even we thought. The fact that any marginal pain will be amplified as trade war weakness will mean that Beijing will do anything and everything in its power to prevent the full extent of the shutdowns from being revealed. And again, we're certain that President Trump has fantastic information about this, but they don't want the world to know because they'll be getting a lot of pressure from all sides. It could cause their currency to crash. It could cause their financial system to crash. They don't want people to know how dire their situation is. So instead of actually publishing fake data that no one will believe, they're just not publishing data anymore. And sure enough, fast forward today, the Wall Street Journal reported that not long ago anyone could comb through a wide range of official data from China, and then it started to disappear. And the timing of this is about perfect, because when we talk about China, they're the world's largest exporter, and we should see their collapse long before us. Now, it's going to follow all across the globe. It's going to get to U.S. shores. We're going to see the same thing happen here, but with a lag. And so the fact that it's happening now as the tariffs are going in effect, we're seeing trade coming into the ports of Los Angeles collapse. This all is in right timing, and now it tells us that China's economy is on the verge of an all-out collapse. So imagine how bad it must be, and when instead of simply making stuff up, China decides this easier approach to simply no longer report the fake data. The best example, surely the Chinese data of youth unemployment, which had a record 22% back in the summer of 2023, at which point China decided to simply stop reporting it altogether. I want to know from you, do you think this means that China's economy is on the verge of collapse? Do you think this is just gamemanship? Weigh in the comments below. Love to hear from you on what your thoughts are, because in most cases, authorities haven't given any reason for ending or withholding the data. But we do know that they've stumbled under the weight of excessive debt, a crumbling real estate market, and other troubles, spurring heavily handed efforts by authorities to control the narrative. You know, when we talked about the real estate market, we've talked about how important it is for them to keep it propped up, because the financial system, the banks have loaned a lot of money to the real estate developers. And if China's economy collapses, well, we already know, we've seen this happen here. It means property prices collapse, and it means the developers are going to default on loans. It's a margin call against the Chinese banking system. And right now, I don't think they want anyone to know just how bad it is, but we do know it's going to get worse. And that's why Beijing will do everything in its power to prevent the full extent of the shutdowns from being revealed. But there's little doubt that the world will soon find out how bad it is there. And we'll know that when China's economy collapses, it's going to spread quickly across the rest of the world. But just because their economy is collapsing and threatening the rest of the global economy doesn't mean your trading account has to collapse. Let's take a look at this trade on GBTC. Many people ask, how do you know when to sell? Well, we let our stop losses do the talking. Yesterday, we were stopped out on this trade we put to our Momentum Timer Pro subscribers on the 14th. We now stopped out for a nice 10% gain, and you too can join us on our next big trade. Hit the links in the description below, grab a coupon code for your free 30-day trial, and stay tuned to the end of the show for more information. Because often the data that goes missing involves area of high sensitivity or headaches for Beijing, such as the property market, which they know if it collapses, it's game over for their financial system. Because remember, what was a recent solution to the problem in the housing market? Force the banks to lend more money into these insolvent developers. because its collapse in recent years wiped out billions of dollars of household wealth and triggered protests by frustrated homebuyers. To this point, one data series that hasn't been banned yet, but likely will be, is China's consumer confidence. Right now, it's never been lower, and you can see that when confidence plunges, it's all about the economy. It's all about finance. It's all about the labor market. And let's take a look at some U.S. data to drive that point home. And let's look at the University of Michigan Consumer Sentiment Survey in blue, which is likely to go plunging lower in the months to come against the unemployment rate in red. And you can see that when confidence goes down, it's all about the labor market and outlook for labor. And what you can see is the unemployment rate in red ticks higher. You can see it going to the 81 recession, into the 83 recession, into the 91 recession, into the dot-com bubble, the global financial crisis. And now we're seeing it happen again as people who are responding to the survey are saying they're worried about their finances. They're worried if they lose their job, they're not going to get another one. And this is the same issue the Chinese consumers are facing. A tumble in confidence is linked directly to the labor market. It's a major red flag, is validating that why the government is covering this up by suspending the publication of data. It means their economy is about to go plunging headfirst into a massive recession, if not all-out financial crisis. And there's more evidence as China plans Wednesday briefing on market stabilization measures. And what they're going to do is look at a financial policy package to stabilize market and expectations. We know that the government's been buying into the equity market, but now they're facing an economic collapse. They're going to have to stimulate at a time when China's already got a massive amount of debt and a property market teetering on the edge of all-out collapse. And the briefing will be closely watched as the country faces intensifying pressure from U.S. tariffs and growing concerns over its economic outlook. And expectations are mounting that Beijing may unveil new measures to steady the economy and shore up confidence. It has no choice because we already know, we've seen this in the U.S. data. When confidence collapses, again, it's all about the labor market and finances. And when people start worrying about their jobs and their money, they quit spending. And the problem that China has is they have a lot of people and they need them to spend to drive domestic consumption, but they just can't do it. Owning gold is often talked about during times of economic uncertainty. While some choose to hold gold to diversify their assets, there are other options to make your gold potentially more productive. Monetary Metals presents an opportunity to turn your idle gold into a productive, yield-bearing asset with the potential to pay you more ounces of physical gold every month. The income is earned in gold, not dollars, not IOUs, but actual physical gold deposited into the account every month. The approach allows gold owners to potentially generate yield while retaining ownership. Go to monetary-metals.com/Stephen to learn how you may be able to start earning a yield in physical gold and silver today. Again, that's monetary-metals.com/Stephen. The risks to any investment. Risks of leasing gold include but are not limited to loss of gold principal from leasing to Monetary Metals and other counterparties, shipping, or any other time gold is in transit. If you purchase gold through Monetary Metals, you may pay up to 0.75% over spot price. Additionally, the price of gold may experience a substantial loss without assurance of rebounding. This is not a recommendation. Before making any investment decision, it's crucial you conduct through research, understand the terms of participation, and assess potential risk. Go to monetary-metals.com/Stephen to learn how you may be able to start earning a yield in physical gold and silver today. Again, that's monetary-metals.com/Stephen. And China services activity slips, adding risk of rapid slowdown, validating that where the manufacturing sector goes. The Cakes in China Services Purchasing Manager Index fell to 50.7, the lowest level in 7 months. Now keep in mind that anything over 50 is an expansion, but just like the US data, when you get under 53, what you're facing is stagnation, a period of no growth, and it's right on the edge of now turning into a massive contraction, telling us that China's economy is indeed going the wrong direction, just as, of course, the government is validating. The question is now whether policymakers will be able to boost consumption fast enough to make up for an expected loss of demand for exports, and the answer is absolutely not. And I want you to see this here in the United States. What is the Fed going to do when we hear from them tomorrow? They're going to say, we're going to wait and see. We're going to keep rates where they're at, when they should be lowering rates. Even if we believe that they don't work, perhaps it'll bring some financial pressure off of households and businesses. Maybe people will borrow and spend, but it's the fact that we're doing nothing. And that's the issue. Is we're going to see this happen in China. We're going to see this happen throughout Europe. It's going to happen here in the United States. Policymakers are going to do nothing and hope everything's fine. and then we hit a massive air pocket and the unemployment rate surges, anything they do is going to be too little and far too late. The state of the job market will go a long way to determining the strength of consumer spending. Goldman estimates that 16 million people, or more than 2% of the Chinese labor force, may be exposed to U.S.-bound exports, and that is a staggering large number of people. And even if that number is way off and is a much smaller number, you still put millions of people on the unemployment line. Well, the problem is for China, they don't have unemployment, so their income goes to zero, their spending goes to zero, and next thing you know, the people that own property, that want to keep it but can't afford it, they start to go into delinquency, then to default, and next thing you know, prices are crumbling, financial systems are blowing up, and you can see why China is suspending their data here, because their country is on the brink of an all-out crisis. But again, I want to know from you, do you think China is about to plunge here in the near term, or do you think they have the staying power? Do you think stimulus keeps them afloat? Weigh in the comments below. Because we've talked about how key global trade is for the labor market, let's talk about imports into the United States, and let's overlay the unemployment rate in red. And what do you see when imports slow down? What happens? Unemployment rate goes up. We can see it again going into every recession. A slowdown in consumer demand, a drop in imports means you need less workers, trade, transportation, warehousing, shipping, all across the board. You see it happen going to the dot-com bubble, the global financial crisis. It even impacts the manufacturing level. Less demand means less demand for workers, and now we're facing a massive collapse of imports. Many people say it's not going to impact the U.S. labor market, but we think just the opposite is going to happen. I want to know from you, is the U.S. labor market strong and robust, or are we going to face major pain? Weigh in the comments below. Because the goods services trade gap grew 14% from the prior month to $140.5 billion. So we're seeing again a massive front running of tariffs. And imports of consumer goods climbed by the most on record, primarily due to the largest ever inflow of pharmaceutical preparations. Imports of capital equipment and motor vehicles also increased. So what we're seeing in China is the forming of this air pocket, this payback period for the global economy, where when you pull forward so much demand, you get to a point where you have a lot of factories that just go idle. Maybe they go broke, but you don't need workers, and next thing you know, everybody's about to experience the pain. They're going to be one of the first, but we're not immune by a stretch of anybody's imagination. And this is even affecting Canada, as their goods exports to the U.S. now fall the most in 5 years after the tariffs, and are likely going to continue to decline. Canadian exports to the U.S. plunged 6.6%, the biggest drop since the COVID-19 pandemic, while imports, and that's internal demand, fell 2.9%. Exports to countries other than the U.S. jumped 24.8%, however, almost entirely offsetting the decline to the U.S., but the jump was driven in part by exports of gold and crude oil. Notably, exporting gold doesn't seem like the best move at this time, but what we can see, again, what's impacting China, now starting to impact Canada. We're going to see this spread all across the world, and very, very quickly. And Kellogg tumbles after trimming outlook on weaker demand as a sign that U.S. consumers are getting tapped out. They've noticed that consumers are pulling away and gravitating toward cheaper private label options as they look to save money. But even Tesla's facing issues as we look to Europe as the Model Y ramps up, but at the same time, sales are plummeting. The company registered only 512 new vehicles last month in the UK. Tesla's plunge was even more pronounced in Denmark, the Netherlands, and Sweden, with sales dropping by at least 2/3 in each country. So we continue to see signs all around the world that consumer demand is plunging. Of course, this is going to impact things at the factory level and, of course, labor. Even in Germany, by far the biggest EV market among European Union member states, Tesla sales fell 46%, even as overall electric car registrations jumped 53% last month. And while the Model Y top sales charts in Norway, the nation's road federation noted in its monthly statement that Tesla's overall sales were, quote, nowhere near the level that we are used to. And that's one of the issues facing the global economy, is that demand is falling. We're going to see demand plunge to levels we're not used to, and that means demand for labor is about to go with it. Let's take a look at what's going on and what's impacting Kellogg's, what's impacting Tesla, and how it's going to impact the labor market as we look at advanced retail sales of adjusted for inflation in blue, against manufacturers' new orders of durable goods in red. And what happens when retail sales go down and inventory levels rise? It means retailers don't need to order as much inventory, impacts manufacturers, and you see in red durable goods new orders go down and eventually contract. You see the same relationship going to global financial crisis, a slowdown in retail sales is nearly flatlining for several years. You see at the same time there's an inventory build, as we've noted in prior shows, and that means new orders, they decelerate. Next thing you know, they come crashing down. Between 2012 and 2015, we see the same thing. Retail sales growing at a very slow pace. New orders dropping, trying to rise, coming plunging down. Again, it's all a demand issue. We see it going into the pandemic, and for the last 3 years, we've seen real retail sales virtually flat at the zero bar. What happens? New orders come down, unemployment rate goes up, and now we're seeing new orders jump. But the problem is we're not seeing retail sales jump as a sign of economic weakness. We know there's more pain coming for, of course, a lot of retailers, but at the same time, it means a lack of demand for labor. As we look at real retail sales, still shown in blue against the unemployment rate, and you can see as retail sales drop, what happens? The unemployment rate goes up. Again, keep in mind, we're a consumption-based global economy. As long as consumers spend and consume, everybody has work. The moment that stops, well, everything falls apart. We can see going into the global financial crisis, what happened? Real retail sales plunge, unemployment rate went up, and now we're facing the same thing. We already know consumers are tightening their belt. We're hearing that from Kellogg's, we're hearing that from McDonald's, we're hearing that now from Tesla. What that means, unemployment rate set to rise and in a major way. But something else that should be headed up right along with the unemployment rate, well, that's your trading account. Let's talk about our recent trade here on GBTC. We got stopped out of that trade, and when people ask how do we know when to sell, we let our stop losses do the talking. We said back on the 14th to buy it open, and we had our subscribers along the way continue to raise their stop loss levels, now cashing in on a nice 10.82% gain. Now, how do we do this? Each and every day we run momentum screens across the broad equity, bond, currency, and commodity markets, and what we're looking for is we aggregate together technical indicators like the RSI and the MACD. We're looking for when they come out of oversold condition, but in a falling market, what you can see is a security can go from oversold to oversold to oversold. So when we pair the trend, well, we call that Momentum Timer Pro. So when we see it coming out of oversold condition with a rising trend, it publishes right on our hot list each and every day. But in addition to that, you get all of the signals across a 1 day, 1 month, 3 month, and 6 month window for everything covered in the report. So you get the daily report, you get all the tradable signals, you get my opinion on the best trades. That's right, I review each and every signal, give you my opinion on what you should take. We give you risk control levels and update them along the way, a full tracking of trades and returns, a weekly update, and here's the best part, you get a free 30-day trial. That's right, we're so confident that you can make money trading our report. We want your first 30 days to be on me. Grab the links in the description below, use a coupon code for your free 30-day trial. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.